Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate jargon because, let's face it, sometimes it feels like they're speaking another language and you'll need a decoder ring for today's filing. We're diving into Limoneira Company, a big name in the citrus industry. This time we're checking an 8K report, mainly about a major loan agreement they just signed. So buckle up and let's see what's really going on behind all the financial talk. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these filings and more with other investors. So Limoneira just signed a big agreement called a Master Loan Agreement, or MLA, with Agwest Farm Credit. Think of it like this. They're upgrading their previous loan setup. This new agreement changes and restates the previous agreement from last year. What does this mean for Limane? It means they now have access to a good chunk of change. We're talking about $115 million in total. $114 million of that is under what they call the revolving credit supplement, and $1 million is under the non-revolving credit supplement. Now, what's the difference? The revolving part is like a credit card. You can borrow, pay back, and borrow again. The non-revolving part is more like a regular loan, a fixed amount you pay back over time. The most important part is that they can use this money to fund their operations and make improvements like buying equipment or expanding their farms. Let's talk interest rates, because that's how the lender makes money. For the revolving credit supplement, the starting interest rate is 6.6% per year. And this is a big but, that rate can change every month, starting in July. It's based on something called SOFR, plus a margin depending on the company's financial health. SOFR is basically a benchmark for how much it costs banks to borrow money. So think of it as a variable rate that reflects the market. They have until July of 2030 to pay this off, and good news, they can pay it off early without getting penalized. Now, for the smaller non-revolving credit supplement, the starting interest rate is a bit higher, 6.90% per year. And this one can change too, but it's up to the lender to decide when and how much. Just like the revolving credit supplement, they have until July of 2030 to pay it off. And again, there's no penalty for paying it off early. So what does Limoneira have to offer as reassurance they will pay it back? It's secured by a few things: company-owned stock, funds they keep with the lender, and some of their agricultural properties in Ventura County, California. Basically, if they can't pay, the lender can take these assets. The agreement also has standard default clauses. If something goes wrong, like Limoneira misses payments, the lender can demand all the money back immediately. This loan agreement also comes with strings attached in the form of covenants. These are promises Limoneira makes to the lender. For example, they have to provide financial reports regularly. They also can't sell off too many assets or take on too much other debt. The most important part is that they need to maintain a certain minimum debt service coverage ratio, which for the layman means they need to generate enough profits to cover their debt payments. Also, a maximum total net leverage ratio, which means they can't build up debt to a level too high compared against their overall equity. If you're interested in the full legal wording, you can check out the exhibits for the detailed master loan agreement, the revolving credit supplement, and the non-revolving credit supplement, all which are linked at the end of the document. The report, like all reports, needs to be signed. This one was signed by Mark Palamountain, Limoneira's Chief Financial Officer and Treasurer. It's a way of saying he vouches for the accuracy of the information. Now, zooming out and looking at this more broadly, what does this all mean for Limoneira? On the one hand, this new loan agreement gives them access to a significant amount of capital. That's a good thing. It allows them to invest in their operations, whether that's planting more trees, upgrading equipment, or expanding their reach. More capital is always a good sign. On the other hand, taking on debt always comes with risks. The interest rates, especially on the revolving credit facility, can fluctuate, which could make it more expensive to borrow money if rates rise. And those covenants, while standard, could limit the company's flexibility in the future. Also, this filing doesn't tell us why Limoneira needs this money. Are they planning a major expansion? Are they struggling with profitability? Depending on where they plan to spend the capital may influence the market for good or bad. We'd need to dig deeper into their financials to get a clearer picture of the broader picture. All considered, Limoneira seems to be setting itself up for future growth. They're betting on the demand for citrus staying strong, and they're willing to take on debt to make it happen. The real test will be whether they can manage that debt effectively and generate enough profits to keep those lenders happy and the company strong. Alright, that's our breakdown of Limoneira's latest loan agreement. What's your take on their financial strategy? Drop your thoughts in the comments below. If this analysis was helpful, hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description below and join our community. Thanks for watching, and we'll catch you in the next report.